Watching a stock investment lose value is painful, but finding a guaranteed tax write-off in the wreckage usually offers a welcome silver lining. You sell the losing asset, lock in a capital loss, and use it to shrink your tax bill. Yet every year, thousands of UK investors have that exact tax shield vaporized by HM Revenue and Customs. They don't lose it because of an audit or a fraudulent claim. They lose it because of a simple, incredibly common timing error. Decades ago, traders utilized a highly effective exploit. They would sell their shares at 4 p.m. to officially bank a tax loss, and then buy the exact same shares back at 8 a.m. the next morning. The market risk was virtually zero, but the tax benefits were massive. This practice became known in the city as bed and breakfasting. To kill this loophole, HMRC introduced a strict 30-day matching rule. It forces a specific chronological hierarchy onto how your trades are paired together for capital gains tax purposes. Failing to navigate this specific rule transforms what looks like a strategic tax deduction on paper into a massive, unexpected tax bill in reality. The trap triggers under very specific conditions. If you sell shares, funds, or crypto outside of a tax-free wrapper like an ISA, and then repurchase the exact same asset within 30 calendar days, you activate the matching machine. HMRC evaluates your trades using a strict 3-tier algorithm. Tier 1 is the same-day rule. Any shares you sell are matched first against shares of the exact same company bought on that exact same calendar day. If there are no same-day trades, the algorithm moves to Tier 2, the 30-day rule. Your sale is now matched against any shares of the same type you purchase within the following 30 days. If a trade doesn't trigger those first two rules, it falls into the fallback tier, the Section 104 pool. This is simply the collective average cost of all the remaining shares you hold in that asset over the long term. This 3-tier algorithm operates automatically. It overrides your personal intent, disregards which specific shares you thought you were selling, and recategorizes the math entirely to favor the tax collector. This animated chart tracks a highly common stock play. Two investors, Sarah and David, each buy 1,000 shares of a company called Innovate plc for £5,000. The market drops. They both sell their entire position for £3,000, intentionally harvesting a £2,000 tax loss to offset gains elsewhere. Just 1 week later, feeling confident the company will rebound, both investors buy back their 1,000 shares for £3,500. Sarah executed these trades in a standard general investment account. Because her repurchase occurred within 30 days, HMRC's hierarchy takes over. The algorithm legally links her sale directly to her new purchase and completely erases her original £5,000 cost basis from the equation. Here is Sarah's new reality. Her sale proceeds of £3,000 are subtracted from her new cost basis of £3,500. Her allowable loss is now only £500. By buying her shares back 23 days too early, Sarah accidentally vaporized £1,500 of her expected tax shield. You don't even have to make these trades manually to get caught. Automated investing, where you set up a monthly drip feed to buy funds, will trigger the 30-day window if you execute a manual sale in the preceding weeks. The hazard is even more severe in cryptocurrency. Because crypto markets operate 24/7, traders frequently sell coins to harvest losses on a dip. Buying back a few days later creates a fragmented, overlapping 30-day nightmare of deferred tax liabilities. HMRC's algorithm does not care if your repurchase was a manual slip-up or executed by a trading bot while you slept. The tax penalty is enforced regardless of your intent. But what about David from our earlier case study? He executed the exact same buy and sell orders on the exact same days as Sarah, yet David successfully kept his full £2,000 tax loss. David used a strategy known as bed and ISA. He sold his original Innovate plc shares from his taxable general investment account, but he executed his repurchase entirely inside a tax-free stocks and shares ISA. This works because HMRC views the ISA as a separate legal tax wrapper. By changing the legal capacity in which the shares are held, David completely broke the chain of the 30-day matching algorithm. The tax wrapper you use dictates your tax reality. By isolating the repurchase, savvy investors can legally bank their past losses while shielding all future growth from capital gains entirely. There are 4 legal methods to maintain your market exposure without triggering the matching rule. Method 1 is the patience play. You simply wait 31 calendar days from the date of your sale before repurchasing the exact same asset. Method 2 is the tax wrapper. Just like David, you utilize a bed and ISA or a bed and SIP strategy to legally separate the trading capacities of your accounts. Method 3 is the bed and spouse maneuver. UK tax law allows for assets to be transferred between married couples or civil partners on a no-gain, no-loss basis. One partner sells the shares, and the other utilizes their independent tax allowance to buy them back, bypassing the individual matching rule. Method 4 is the proxy asset. Instead of repurchasing the exact same Vanguard S&P 500 ETF, you buy an iShares equivalent. You maintain your market exposure, but because the asset class is technically different, you bypass the algorithm entirely. Tax compliance isn't about sitting out of the stock market. It is about navigating HMRC's exact legal definitions of time, capacity, and asset class. A thorough understanding of the 30-day rule separates the investors who pay unexpected penalties from those who legally maximize their long-term wealth. UK tax laws are highly complex and subject to frequent changes. The strategies discussed here are educational and do not constitute formal financial advice. To safely implement these strategies, you need a precise evaluation of your personal portfolio. The experts at My Tax Accountant are ready to untangle your capital gains issues and map out a shielding strategy tailored to your exact needs. Protect your returns and stay ahead of the regulations. Subscribe to the My Tax Accountant channel today for more essential UK tax strategies.